In this video, we're going to talk about the 7 biggest mistakes business buyers make. My guest is John Martinka. He's helped over 100 clients with biz buy sell transactions. He's been in the M&A advisory business for over 20 years, and he's also author of 5 books, which I have 2 right here, and they're available on Amazon. Welcome to the show, John.
Yeah, thanks for having me.
Yeah, so let's jump into this, but I want to get a little your origin story. How did you get started in this M&A world?
Serendipity. How's that for an answer?
That's great. Serendipity is always a great.
Yeah. My background is, I guess I got the entrepreneurial spirit in college because my friend and I set up a business painting houses. We were both pretty handy kind, and my dad was extremely handy. I learned a lot and did that through college and then grad school, and even during a recession for a while. And then, I did some other small business things. Actually, my first real job out of college was in the concert business with the concert promoter in Milwaukee, where I grew up. And then we moved to Seattle. I did some sales things. And then I was back-to-back presidents of a Rotary Club in Kirkland, Washington with Ted Leverett, who you know. And one day after a meeting, as we had become friends, Ted said something like, "I've always thought you'd be good in this business." And one thing led to another, and here we are.
Yeah. And what was the business? Like, hey, Ted said you should help companies buy other companies and grow by acquisitions, or what did that start as and evolve to?
Well, it really started as we were building a network of people around the country to learn from Ted and what to do to help people buying a business and, other things, whether it's evaluating franchise opportunity or just getting the business ready for sale, things like that. And then I really like what I do, helping buyers. And we do some work on the sell side. I say we, my daughter is part of the business now. And it's variety. Every day is different. Every hour is different. There are challenges, there are rewards. And, one of the taglines we use is changing lives via business transitions. And that's what we're doing.
Yeah.
It's often the biggest thing most people would do is whether it's buying a business or selling a business, biggest risk, the biggest financial, all of that.
Let me kind of get something clear on the table. What kind of business buyer do you help? There's a whole bunch of coaches out there that'll say, "Hey, buy this distressed business, turn around." There's people that are out there saying, "Hey, buy this business with no money down." What kind of business buying advice do you give, and what do you look for?
Okay, so I'm a big believer in the 80-20 rule, and 80% of like the old 80% of your business will come from 20% of your customers or whatever else. What you're talking about is the 20%, the fringe stuff. Most people can't buy a business with no money, not a mature, profitable business. Because if you're a seller and you got a business that's cranking out $1 million a year, why would you sell it to someone who has no money to put into the deal when there are scores and scores of good buyers out there who do have the money and the credit worthiness?
Good logical question.
Yeah.
Yeah.
Our clients, we tell them what to focus on. Again, it's a mature, profitable business, a fairly priced business. Don't go chasing things don't go chasing dreams. I've been doing this since the 90s. I've had, out of all the clients we've had, 4 buy a distressed company. Every one of them knew it was distressed, why it was distressed, and what to do. And they did it. But for the most part, if you want to come in with no money down, you're buying a fixer.
Yeah. So what's your ideal profile client? Is it a millennial, Gen Xer, or baby boomer in different stages, just that wanting to buy a business?
Well, that 80% are typically people from 35, 40 to 60 years old.
Yeah.
And I know the market is flooded with a lot of young buyers now, but if you get to be 35, 40, that chances are you want to own a business, chances are you've built up some experience. You've managed people, you've managed processes, you've managed money. And I like to add, as an owner, you need to manage enthusiasm.
Oh, interesting. Yeah, I love that. And when you qualify these buyers to help them, are you look at their balance sheet? What are you looking for? Are you looking for somebody with, 250,000 in balance sheet, cash assets, or 500,000 or a million, or what?
Well, before we get to the money,
Yeah.
the other two legs of the three-legged stool are the right skills, just that we just talked about. Having managed and led and done something, and a good personality.
Yeah. I
And
call that experienced operators. You got to have,
yeah,
if, if you do happen to go after investors, you got to be an experienced operator too.
right. You're
You're not
right.
going to put a lineman in a quarterback's role.
Mm-hmm. You're right.
Yeah.
And then the good personality is you gotta be a nice person. You gotta be able to convince a seller that you're gonna take care of their baby. That they're gonna come back by in 5 or 10 years and see the name on the door still and tell their grandkids, hey, that was my business. Look how good it's
Yeah.
doing. And then we get to the money. And then again, the money has to be appropriate to what they want to do, what size business, the salary they want and need. And as you know, banks will look at a buyer and their profile. And, if a buyer comes in and says, I have $250,000 and I need a business that will pay me $250 a year, it's probably not going to happen. And the bank is going to say, well, look, you need $250 a year. You're going to have to buy a larger company and you can buy with $250,000. Because the last thing a bank wants is the buyer to go in personal debt.
Yeah.
And it's the same thing, buyer comes in and the opposite and says, well, I'm willing to take a really low salary. Well, that doesn't matter to a business appraiser. A business appraiser will look at it and say, what's the fair market salary for running this company? And that goes into the expenses to calculate the value.
Yeah.
Then the buyer
So,
can take less if they want.
so you got these, of course, a good deal, and you got an experienced operator, and you got the money, the three-legged stool. Uh, let's talk about the buyers when they start this journey and the 7 biggest mistakes that they make. That like Warren Buffett usually call this like I just avoid the dragons.
Yeah.
It saves me a lot of time and money and heartache. Yeah.
Okay. So we got to narrow it down to 7, huh?
So, well, if you got more, let's hear it.
No, 7's a catchy number, isn't it?
Yeah.
So in no particular order. Uh, uh, but this one does really come near the top. Realizing that searching for a business is a contact sport. The more contacts you make, the better you're off. Your search is going
Contact
to be.
sport. I like that. Yeah.
It's sales. It's a sales effort. You can't sit back and wait for the phone to ring. You have to do things. And tied to that, when you find one you like, you don't quit prospecting. There's a
Right.
lot that can happen between I met the owner, I like the business, and getting it closed. What else?
And is this off market or on market or both?
Both.
Yeah.
If all you're going to do is peruse bids, buy, sell, you're going to see a lot of junk, and you're going to be, if it is a good one, you're going to be in competition with other buyers.
A lot of other buyers, because
A lot
that's
of
the
other
most
buyers these days.
trafficked site for selling businesses.
Yeah. It's recognizing that there's a lot of talk out there. I know you had Richard Parker on a while back, and Richard and I are good friends. And I know in his materials, he has always said 90% of people who say they're going to buy a business never do.
Yeah.
And I actually think it might even be a little higher these days, with all these people taking classes on buying a business, entrepreneurship through acquisition. And, it's a challenging process. It takes a year, 2 years. Uh,
Well, what do you think the numbers should look like? It's just setting expectations with somebody. Should they look at 1,000 businesses? And here's why I had this searcher from an ETA search funder group, and he was a younger kid. And he said, I asked him how many businesses he's looked at, and he goes 4,000. I go 4,000. You couldn't find one business in 4,000?
well, there is the crux of the issue is that when everyone says, Richard's materials came out 30 some years ago, and others have say the same thing on that 90% or more, is that there's a lot of people like that person you're talking about who look at a lot but never pull the trigger. You could put
Yeah,
the perfect business with a great deal in front of them, and they're going to find a reason not to do it.
yeah,
You know, they're not in it for the kill. They're in it for the excitement of the hunt.
yeah. And I don't think he's probably the right person to buy a company.
Yeah,
He's not. He's telling us that.
right.
Yeah,
So
yeah.
okay, so what else?
All right. So number
Another
two,
mistake.
no, in no particular order.
Yeah. I like to make an analogy to the chess game of chess, and in chess, the king and the queen, and in businesses, cash and cash flow is king, but the queen is the most important piece in the game, and the queen in this case is relationships.
Queen is relationships.
Not recognizing that the buyers want the sellers want to sell to somebody they like, they trust, they respect to take care of their business. And I've seen buyers, they've said, "Oh, I just sent over this IOI, I just sent over this LOI," and they just pulled a number out of the air. They never met or talked with the seller. It's just, oh, the broker, the intermediary, banker said, we're taking. We need an IOI by such and such a date. Oh, here's an IOI. And,
That's just clicking the buttons, right? There's no relationship or back behind that.
I talked to an owner the other day that I know and have known for 20 years, and they're selling. And there was a particular buyer I mentioned, and he said, everyone else asked good questions. He didn't even ask for a call with us.
Yeah. Well, I got a good story on that. I interviewed a guy quite a while back. He bought some foundries, and he bought a fencing foundry for $1 million less than three other bidders because he drove 5 hours to meet the seller and had spent like 2 to 3 hours with him.
I've had a few situations like that. One in particular, my client Mike, there were 3 offers on the business. His was the lowest, and he got it because the seller said, "You're the guy to take over my company."
So it's peers selling to peers, or would there happen to be, unbalance to that possibly just because that you could make up with a relationship?
Well, I think you can make up with a relationship that if a seller says you're the one I want to sell to, they're gonna, you got to be reasonable on your offer.
Yeah. Now you're working together
Yeah,
to get all the asset purchase agreement and moving forward.
yeah. Let me give you a great story on that. It goes back quite a few years. And my client, his name is Ted. He bought a company that does they design the product, have it manufactured by contract manufacturing, and then they distribute it. And we're in due diligence, so we know the sales are going down. Pipeline doesn't look that good. And the seller said, well, yeah, the reason is, and the reason he was selling, he'd been in the business for 40 some years, having started at like age 13 when his dad owned it. And he started another company, and he started playing with the other company. And he says, I know what to do. And he says, give me some time. I'll get things back on track. A month later, he calls Ted and says, come on in. And he hires him on what I considered a very lucrative consulting engagement to do nothing but be his buyer, wait till he got it back on track, and learn the business before closing. Because he said, you're my guy. I don't want you going out and finding another company.
Yeah. Oh, that's a great story.
That's a relationship.
Was that kind of like a lease to own? You come in, you work for me, and then I'll start selling this to you, seller financing, or was it just
he was just learning the business. He was tying the guy up at a nice fee per month so he wouldn't go find another company.
Yeah. There you go. That's a strategic move, wasn't it?
Yeah.
Yeah.
So
Yeah. All right. Number
another
3.
one.
Yeah.
You just talked about the guy who's looked at 4,000 deals, not recognizing there are no perfect businesses and no perfect deals.
Right.
You won't find it. Don't look for it. Look for something where there's opportunity. And what I'm
Unpack
seeing,
that for me. Opportunity because you see the arbitration, or
well, so the buyer sees what they can do with the business, and there are, a good buy. Let's say you take a good buyer. They're 40 years old. They've got some ops experience. They're completely comfortable with technology, and they buy we'll call it a legacy business, making something, distributing something, and they bring in productivity enhancing tools.
yeah, could be technology, could be software, could be just new processes.
Yes,
Yeah.
and documenting processes and everything else. That's opportunity. And you're not, a buyer should be looking for something not with warts, but with opportunity.
With opportunity. And have you ever seen somebody, one of your buyers, come in with too much enthusiasm for opportunity?
Yeah, and that's part of our job to temper that. Uh, I like to say that half of what we do with our clients is quasi therapist work. Sometimes it's bringing them down because they're so excited, and other times it's getting them out of analysis paralysis.
Yeah.
And that brings me into another mistake. And I like to say the bigger the spreadsheet, the less chance of a deal, because you're going to get analysis paralysis.
Yeah.
The private equity firms can do the massive spreadsheets. The buyers, we're talking about the corporate executive wanting a business, the small business owner wanting another business, stuff in that SBA range and maybe up to 10 million or so. You don't need the massive spreadsheets. You need to build a relationship, find out what's going on, and look for the opportunity. And it's like you mentioned Warren Buffett before, and I know he says things on like Diligence. I don't worry about the lease. Yeah, there's going to be a problem with the lease. I want to know, how is this business going to be in the upcoming economic forecast.
Yeah. Has it weathered, through ups and downs in the roller coaster? So I have another story. I interviewed a guy from a private equity company that bought a landscaping in Georgia, and he did what he learned how to do, which was put everything in a spreadsheet and go. And then he had these conversations with the seller, who was just a guy, a blue collar worker, just like, hey man, I cut lawns. I don't know what you're asking me. He goes, I threw everything out and then I just went with my gut and bought the business, and it's doing real well. Yeah.
Yeah.
So number 4.
Oh, let's see. What could number 4 be? It's tied to what we just talked about a little bit, but don't fall in love with the product.
Yeah. The product being the company, or the product being the product that the company makes?
They make this wonderful widget. That widget is so cool. I wish I had 10 of them in my house. I want to buy this company. Fall in love with the business model and the value proposition and what you bring to enhance that value proposition.
Yeah.
In other words, you want a business with a defensible competitive advantage.
Yeah. Let me ask you a question. If all 3 check mark, for instance, I got another story. I got a partner looking at a business in California. He's a pilot, and this company makes props, which is very exciting. The business otherwise is very, it's very profitable. Definitely has a defensive competitive advantage, but it's also a really cool product because the seller also buys and sells planes. He owns a P-51.
Yeah.
And he goes, look, if you buy the company, I'll give you a ride in it.
Yeah.
Yeah. Which is a nice sweetener, but you're starting building these sandcastles going, you have a tendency to overlook creates blind spots.
Yeah.
Yeah.
You're right. That's exactly it.
Yeah. All right. So number 5. And we could keep going with these.
We
I
can
like
keep
these.
going. Yeah.
Yeah.
Don't get greedy.
Don't get greedy.
Buyers will get greedy. I've seen buyers that would spend a lot of time negotiating an eighth of a point on the bank loan. It's like, get the darn deal done.
Yeah.
Yeah. I'll say to somebody that, say, I don't know, I don't want to pay more than 3.6 million for this company. And I said, so if you paid 3.7 and the business does what you think you can do you think you'll be looking back in 2 years laughing about it?
Yeah. I read that story when Warren Buffett bought See's Candy. He says, like, I wasn't going to pay over $27 million or something like that.
Yeah.
And this has turned out to be a billion-dollar business, cash flowing for 40 years for him.
Yeah.
Yeah. And I regret trying to be greedy, trying to, like, putting a line on this price.
Mhm.
Is there a stop where you say, 2.7 versus 2.2, where you just like,
Yeah, that's a big gap.
yeah,
That's a 20% gap. But if it's close, get the deal done.
yeah. Because, and I'm going to make this point, is if you're bringing your skills as an operator and you see opportunity there, you're going to be able to make up that 1 point.
Yeah. Right.
Right. Very nice. All right. Number 6.
Let's go with not understanding what free cash flow is.
Okay.
We hear the term EBITDA all the time. Now, look, if you have a company that has a bunch of people in the office doing stuff on computers, and your depreciation is next to nothing. But you talk about your guy at the foundry, they may be, they're spending a lot of money on equipment. It's a classic example, makes a point very easily is, well, the EBITDA for this distribution company is $2 million, but they have, I'll just use easily divisible numbers. They have 21 trucks. A truck's life is 7 years. That means they're buying 3 new trucks a year, every year.
Every
They're buying
year.
3 new trucks to
Yeah.
stay in the same place. Those trucks, they may, whether they're 50 or 100,000, that's 150 to 300,000 a year. It's cash out the door.
Yeah. And depreciation is important. Yeah.
It is important. And I hear this line all the time from, it goes back to the old days. Depreciation is not a cash expense. Well, the payments to the bank of principal after tax is a cash expense.
Right. Especially if you having to replace 3 new trucks every year. Yes.
Right.
Yeah.
And you look at, we work with a client who's become a friend who owns a concrete cutting business. For him to get a new truck, it's over $100,000 with all the equipment on it and everything else. He wants to expand, $100,000. You look at retail businesses that may have 5 locations. How do you grow it? You put in a 6th. What does it cost to put in a 6th? $500,000. That's real money.
The incremental cost is, this is a funny question because it's not funny. It's just what you brought up. The guy that my partner's looking at to purchase the propeller company, he got a very large catalog company that sells other props to ask him, can you build these for us?
Yeah.
And he goes, well, I'm at 80% capacity with my Masac CNC machines right now.
Yeah.
I can't handle it. Like, if he were to take the business, he'd have to open up a completely new location and possibly buy at least two new Masac machines.
Yeah.
Yeah. Which didn't make sense to him, to his lifestyle and what he wanted to do. I don't want to work 100 hours a week. Right.
Yeah.
Yeah. That's a good one. Free cash flow. Can you unpack that a little bit more about the free cash flow?
That. That's a really interesting subject I can get going on.
Yeah, that's.
So, what do you see when you're out there looking for a business? You see EBITDA and EBIT and seller's discretionary earnings,
net income.
Yeah. To me, seller's discretionary earnings is a very misleading term. In fact, it's quasi-fraudulent to put out a business and say, well, this SDE is $500,000 because the owner's comp needs to be 150. That means your net income's really only 350. But they advertise that. And what are I have never seen a bank do their calculations and not put in a salary for someone running the company, whether it's the buyer or a CEO.
Right?
I have never had a business appraiser say, oh yeah, whoever's running the company is not going to get paid. That's an expense.
Yes.
So, I mean, if you look at
that's not an illegitimate add back.
Yeah. So add backs are another thing that we can get to. If you look at companies' financial statements, here's what I like to do. You calculate the EBITDA and you add back the owner's comp, and then you subtract out fair market owner's comp and anticipated CapEx. And if the company's been using a line of credit, that operating interest is probably going to continue. So you subtract out operating interest, not acquisition interest, operating interest. And that should be your free cash flow. And that's what you have to pay for the business, grow the business, pay taxes, etc.
What cushion margin of safety should be in there?
Depending on the size of a deal, I think the debt coverage ratio, which is simply principal and interest payments to free cash flow, you should have at least a 1.5 to 1 coverage. I know there are banks that will go down to 1.1, 1.15.
Yeah, I've seen SBAs like 1.25, but some SBA banks will go, it needs to be 1.5. But anything above that is great, better.
Yeah, and if you're buying $1 million company, you want it to be 2 to 1 because the absolute number isn't that high. That's your money to grow the business.
Right.
And
you don't, because I can see what you're doing. Because I've been in this situation before. It's like you just don't have any cash to do anything.
Yeah.
You don't have any cash to grow. You don't have any cash to put in more marketing, blah, blah, all of it.
Right. So if we look at the last year and a half with what's happened with interest rates, think of all the buyers who got a variable loan, 5.5%, and now most SBA loans are around 10 to 11.
It's 11.25 plus 3 to 5% for closing cost.
Yeah. But just say let's just go back. You got the business 2 years ago, 5.5% interest rate. Now the bank has raised the interest rate to maybe not to what a new borrower would get, but say 9, 10%. Say 10%. That's almost double your interest. And in the early years of a loan, just like your mortgage, interest is higher than the principal.
Yeah. Sounds like the GDP.
And the bank
current U.S. government, right?
The banks that were out there with low debt coverage ratios just to make loans, I think are feeling the pinch of borrowers who are having trouble.
Right.
And if they were so strapped that they didn't have that cushion to grow it for a couple of years, it's not pretty. So
what would you do? You see opportunity presents itself when other challenges come up. If you go to a business and it looks like it's pretty good cash flow, let's say it's marginal, but then you're qualified for SBA bank and you go, wow, 11.25, then 3 to 5% for closing costs. This is going to be too tight. Is there anywhere else they can go to purchase this kind of business? And it's a motivated seller.
Yeah, they get an equity investor, minority investor who's going to be under the 20% that they don't have to sign on the bank loan.
Yeah.
And here's the other thing. I'm seeing more seller notes, and I'm seeing larger seller notes because the seller interest rate is going to be less than the bank interest rate. and that gives the buyer a blended rate that is lower.
Yeah. And the benefit to the seller for a seller note is, of course, he gets to sell the business, right? That transaction happens. Is there tax benefits to the seller?
Well, they're going to get the price that they want. That I don't know. That's not a tax benefit, but it's an overall benefit.
They're going to get it over time, right?
Yeah. So if somebody says, "I'll give you $4 million for your business if you'll finance X amount at 6%," when the bank's at 11, they can pay a little more.
Yeah.
And they get, if it's the right buyer, they're gonna want to do it,
right?
or they should want to do it, because it is having an effect on valuation. It is starting to kick in a bit. Buyers are a lot more conservative. It's taken them about a year to catch up with all the interest rate stuff going on.
Yeah.
But seeing lower offers and lower multiples, not drastic. I mean, not talking a multiple going from 5 to 3, but if you go from 5 to 4.5.
Right. This is something that it's completely different than the real estate industry. You can see those interest rate pressures pushing down, real estate quite rapidly. We see it because so many are people into it. But businesses, you don't see this like immediate effect. It's just there's a business over here that's HVAC in Arizona, and there's one in Florida, and they're not affected by each other based upon valuations. It's just who comes to buy it.
Right. Yeah. And it's taken a while versus, real estate, where it's, like you said, it's pretty instantaneous. It's taken a while for buyers to recognize that. I think it's taken a while for sellers and their advisors to say, yeah, this is what's going on. Your interest rates are a lot higher. It's going to cost them more to finance it.
Yeah.
Prices come down, finance more. Buyer can get the equity if they want to give up some equity. It seems like there's developing a whole industry of people who arrange minority positions on these deals.
I see it. I don't see a big effort succeeding just yet. I mean, if I look at, for instance, like the startup industry where they have angel list, that's 100,000 investors willing to put 10,000 to 50,000 to 100,000 or more in anything that comes on the market. Like, there's no group of those types of individuals, somebody put them together just yet. I could be wrong. If I'm wrong, please let me know down in the comments.
There are some groups out there and people I know that do that. I'm not giving a plug, but Search Investment Group in Texas does that. They've got a roster of investors, and they cut deals. Nice guys. But if we go back to the banking thing, there's about 2,000 lenders in this country.
Yeah.
And a lot of them do SBA loans. And there are some that will lend on anything to anyone just to get the loan.
The numbers.
And, a buyer should want a good bank, a good banker. They want the bank to do as good a job on underwriting and bank due diligence as they're going to do on their due diligence.
Yeah.
It should want that.
Absolutely. It's like it's a second point of view that you missed. Like,
yeah,
I need this to be peer reviewed.
Right.
Like, I see a lot of people, buying a business that are not, they don't understand the language of business, which is accounting.
Mm-hmm.
And if they get a rubber stamp on underwriting, like, that's it. That's the gold standard for them, and they move forward.
Yeah.
But I think they should always go back and learn a little bit more about accounting, so you can tell about trends and make it changes.
Yeah. And as an owner, especially if you're not a numbers person, and there's a lot of great owners who are not numbers person,
right,
is to hire the right people around you. And a couple of things that I've recommended lately more than ever to buyers and owners is first of all, get an outsourced HR firm involved. The HR, is just a a field of landmines. I mean, there's little things that can trip up a company and get them fined if they don't do some of the things the right way. It's not just having a 5-year-old policies and procedures manual. Laws keep exploding in number on HR. The other thing is a CFO controller. Um, Whether it's the owner or the buyer, a lot of times the accounting department is like, I call it the weak little redheaded stepsister off in the corner. I love working with the product. I love the customers. Yeah. Go take care of everything over there, and give me a statement every month. But get someone who really knows what they're doing and can give management reports that can show trends, can show your KPIs that you need.
I'm going to reference this same business out of California we're looking at, run by husband and wife. Wife runs the accounting. She's not an accountant. She's not a CPA. She's not a bookkeeper. And she sent the income statement, and I said the chart of accounts are off. You don't have, you're a manufacturing company, and you don't have the cost of goods in the right section. It's somewhere down here in G&A and expenses, and I can't really tell how much you're spending on it. But there's no way to fix that because she can't fix it.
Yeah. Well, I'll give you a good one too. I was talking to a business broker. I looked at one of his memorandums, and the financial statements, and I called him up, and I know the guy well, and I said, "How confident are you in the financial statements for this company?" And he said, "Oh, 100%." And I said, "Then why are there balance sheet items on the income statement?"
Yeah.
You think before you take a business to market and you send financial statements out, you would at least review them for basic stuff like that.
Yeah. Let me ask you about that. I think they're all important documents, the financial report cards, the balance sheet, income statement, and cash flow statement. But most of the time, you're just going to see the income statement from these small businesses. I think the balance sheet is more important. It tells a story about, the money they used and the debt they're using, and the cash flow and everything else. It tells a story. I look at them all together, but if I look at the income statement, I said, hey, that net income or EBITDA, that's a theory. That doesn't really tell me how much is in the cash account or how productive they are turning assets to cash flow.
I agree. I usually look at the balance sheet first if it's there.
Yeah.
And then go compare them. And I like to first look and say, is the net income on the P&L the same as the net income showing year to date on the balance sheet?
And if it's not,
sometimes it isn't. But right. The balance sheet tells you, are they what are they doing with assets, and are they bleeding the company? There's, we're doing 8 million a year in sales or 18. It doesn't matter, and the cash account is low, and working capital looks normal, but owner distributions are off the chart.
Yeah. So why do you have a couple Maseratis? Yes.
Yeah.
Exactly. All right, number 7. I think we're on. We talked about cash flow a lot. Thank you.
Yeah. Oh,
that is actually it's the lifeblood of the business. So
it is. Yeah. It is. Cash is king, as I said before. Cash flow is king. So let's just go. A big mistake on the big picture side is not recognizing you're going to make a leap of faith. And in the preface to my book that's aimed at the individual buyer, it says, you're going to make a leap of faith. You want to make it off a chair, not the roof.
Yeah.
And that it ties into both not being too defensive, because again, we talked about there's no perfect businesses, but not getting buyer fever.
Yeah.
You're making a leap off faith off the roof when you get buyer fever.
Yeah. I like that analogy. It's I might evolve it a little bit to say, if you're going to jump headfirst into a pool, Probably should wade into it and see if it's deep enough.
Yeah. Yeah.
Yeah. Do you have stories about that? Specifically anecdotal stories with that cautionary?
Yeah. And I'll tell you, when you get buyer fever and you really like something, I'll tell you, I won't use the guy's name because this is not a pretty story. So offers in. It was a nice sized company. I mean, we're not talking about a small business. This is a nice, multi-million-dollar deal. And it comes time at the end to do the final due diligence. And to me, final due diligence is talking to employees, management, and customers. Generally, there's a requirement. Hey, we'll at least sign the purchase and sale agreement with a contingency for that. So we get time to talking to the customers. And a husband and wife owned it, and she's the one who just said, no, can't have you talk to the customers. This industry is very tight. Word will get out. Something's going on. I told him, you need to put this deal on hold. His attorney was a little stronger, said, kill the deal. He said, no, I trust her. I understand completely. It'll be okay. Comes to find out, and this one did have customer concentration, which was handled in the valuation of 25%. That top customer, while we're in due diligence, was doing due diligence. We'll call it a test kitchen of all the competitors' products and services, and didn't invite their current vendor.
Ooh,
the company he
okay.
was buying, because they were so sick of them nickel and diming them over the year. This is some product, a service where you make a big investment in it, and then there's upgrades and maintenance, and they just felt they're just taking advantage of us because we can't go out and replace what they have every other year. This has got like an 8 or 10 year life before new equipment, and they were just sick of them, and they didn't even invite them to bid.
Yeah. Did the buyer buy the business?
Oh, this came up after.
Oh, it came after. And did
Yeah.
the customer drop them and
Oh, yeah.
25% drop in revenue
Yeah.
immediately?
Yeah.
Was there any attempts to win them back and say, we're not going to do that again?
Of course there
New
was,
owner.
but they were,
Yeah.
excuse my language, they were pissed off.
Yeah.
And the lawyers got involved, and there was a settlement and all of that. But it was, there's a self-inflicted wound, because the lawyer and I both said, don't proceed on these terms. That's buyer fever.
Yeah. What's your the buyer fever. In the human body, the doctors used to try to minimize the fever, but the fever was the whole process of correcting or healing the body.
Yeah.
It should happen. Do you think about due diligence, outsource it or do it yourself? And the reason I brought that up is I just had a conversation with another, I call him mentor. He's holding a little holding company. He's 84 years old, but he goes, look, John, we do all the due diligence ourselves. We get in there and do everything. We're the financials. We go to the customers. We go to the suppliers. We do it all ourselves because I'll know more about that business in the first 3 months than the guy selling it did.
What size companies is he buying?
Anywhere from $1 to $10 million.
Okay. Yeah. So in the smaller deals, I think most of it should be done by the buyer. Obviously they can't do any legal due diligence, and if they're not financially astute, they should have a CFO or an accountant be helping them on the financial side. The buzzword these days, and I hear this all the time, well, should I get a Q of E on quality of earnings on this company? It's like, this isn't that big a deal.
Yeah. You got $30,000. Yeah.
Why do you need a quality of earnings? And I will give the CPA profession credit for creating a great marketing term, quality of earnings. You know what we used to call it? Mini audit.
Mini audit.
Mini audit is not sexy. Quality of earnings sounds sexy.
Oh my God, that sounds official.
Yeah. But if you're in the PE world, you have to get it done, because your investors, if anything happens, they're going to say, why didn't you do a quality of earnings?
Yeah. That would never happen because they like we're putting a multiple on this business based upon we think these customers are going to be ordering from us for the next 5 years.
Yeah.
Okay, great. I don't think you can do that with small businesses.
No.
Yeah.
But you can go in and tear apart the financials and I mean, what are they doing? They're seeing, is the cash flow really the cash flow?
Yeah. Would you sick if you saw, for instance, going back to my example, like the chart of accounts is messed up. They don't have the cost of goods in the right place. Would you sick a CPA on this?
I would suggest a CPA or a CFO type.
Mm-hmm.
What is your true cost of goods sold? Now, let's also face it. If you say a company's doing, just say 5 million in sales and making $1 million, are you going to worry that much about it versus, hey, I got a company doing 5 million making 200,000? Then you're gonna dive in a lot more and say, what the heck is going on that your margins are so horrible?
Yeah. Yeah. Well, it's not financeable. I mean, I can't borrow money to buy that.
Yeah. Well,
Yeah.
I mean, you can't borrow money to pay the same price, but yeah, if it's making 200 grand and you're going to pay 600-800, it's all relative. I'll
Right.
tell you, something I learned, great term. There's a guy who was he was the president of one of the divisions at Expedia. And his line was, growth hides a lot of operational warts.
Yes.
And he also said those warts tend to work their way out.
Yes.
Yeah. Whether it's, well, our cost of goods sold could go down by 2%. Well, get in there and do it. Don't obsess over it. Grow the company so that you're buying materials at a lower rate.
Yeah. Can I rewind a little bit, because when you were talking about people and being a nice person, and the question has to do with like, if I come in and I'm a numbers guy and I run the business on numbers, but businesses are run by people, should I be an inspirational person to help people want to come into work and then
I
come
would
back
think
tomorrow?
so. I mean, there's a lot of numbers people who have good personalities. I mean, stereotypical, the old green visor and lamp of an accountant in the corner, or like in a Christmas Carol, just writing numbers or
Yeah,
entering
that's
numbers.
Charles Dickens. It's not going to work.
You got, there's a lot of numbers people who can motivate. But you can't sit in the office. I don't think you can sit in the office and just analyze spreadsheets like you were talking about with your guy in Georgia, and be as successful as you would be if you're out there with the employees. I just read, I think it was in the Wall Street Journal today, that there's some dissatisfaction at Starbucks, and the new CEO is getting out and meeting the rank and file workers and going and getting to know them. Not all of them, obviously, thousands, but he's making an effort to do that, to see and asking them what they would like to see happen.
Yeah. What's the danger in that? Like, if you start talking to baristas and they say, hey, we need more Starbucks with pink cups. I don't know.
Yeah.
Like,
Well, probably what I would think more than what that they're going to say something like, the equipment gets kept around too long and it gets difficult to use.
yeah, you have to filter through that, right?
Yeah.
Yeah.
What and it isn't just like, what would you want to see, but what could we do to make your job better and the experience for the customers better? And they're not going to say we need multicolored cups, but
Yeah.
they're going to say, these machines, we've got to do maintenance on them every other day. It should be every other month,
Right. Serious filtered
Yeah.
suggestions.
Yeah.
Yeah. All right. So number 8. Is there a number 8? Do you have a
There
number
could
8?
always be a number 8.
What do you got? Like 8 to 20, and you go.
Oh, I mean, there's just so many things that go on in buying a business. Yeah, that's just I think a mistake that and the mistake that a lot of buyers make is they want the secret sauce up front. They don't recognize, you got to put an offer together and get it accepted before you get in to see the secret sauce. The secret sauce could be the name of the customers, or the exact name of the employees, or
So tell me a little bit about that. What do you mean, like the secret sauce of the business? Are you referring to like what really makes the bell ring in the
well,
business, and that the buyer can't see or just
no,
not
I'm talking about
visible
the
to them?
things that like I'll just see. I like to use the term secret sauces. Sort of the stuff that the owner, the business has that gives them a competitive advantage, and some of it's perfectly explainable. We make the best product out there, but
Yeah,
we've got a really
yeah, but why
loyal.
do you make the best product?
We've got really loyal customers. Okay, show me. Well, customers A through Z, look at them over the years. They've been with us for 10 years, and here's their percent of sales to those top 26 customers, to each one of them, and notice how it bounces around. But at that point, you don't get the customer name.
Yeah,
But when you sign an offer, you get due diligence, you get the customer name.
this is a leap of faith, right?
Yeah. I mean, if you were selling a business, would you show your list of customers with how much they do, uh, to everyone that came in the door, saying I might want to buy it?
Not everyone. Probably some individuals that were serious, had the money, and looked like they're qualified buyers.
Yeah.
Maybe when it was down to 2 or 3, probably.
Right. Or
Yeah,
or I like to think that I see mostly in the process, whether it's the customers or access to employees, or some other things, it's after an LOI is signed,
yeah,
and then
yeah,
you're in due diligence.
yeah. What's your thought about that? You sign this LOI, you go due diligence, and it's time to talk to the employees. It does, hey, why are you talking to me? By the way, I'm selling. The
You,
first thing that comes to mind is like, oh, are you shutting the company down, or should I expect to
yeah.
get fired, or what's going to happen? Or I'm going to get a reduction in salary?
That's why confidentiality is the most, or breach of confidentiality is the most dreaded term to a business seller.
Yeah,
And uh, generally it would be the senior people in the company. I mean, you wouldn't go out if you got a
yeah. You're not
factory
going to
with
go out to the
40
line.
people. You're not going to hold a meeting and say, "Hey, this guy's buying the company." But before you close on the deal, you're going to meet the 4 people who are, the sales manager, the ops manager, the financial manager, etc.
Yeah,
And look, a smart seller will bring them in. And they say, "Look what I'm doing. I'm at the age. I need to retire. I need to do something else." And the really smart seller will say, "And when we get this close, here's a retention bonus. If you stick around with the buyer for a year or whatever, here's money that'll go in an account for you."
yeah. In some kind of escrow. Yeah,
Yeah. If you're selling $1 million business, that's probably not enough. But if you're selling, I've seen it done, business selling 3, 5, 7 million, that they do that, because people are what make the business also, right?
yeah.
Yeah.
Well, that was number 8, and we got time for one more. Number
One more.
9. Yeah,
Hmm. Oh, what can we talk about, John? There's so many. I'm trying to think of some good stories. Here's one I think you'll like. It's, don't think that when you buy a business, that's, first of all, that you got to fall in love with it like you're getting married to it. Think that, hey, this is a business and I may not be in it longer than, say, 5 or 10 years. But at the same time, don't think it's the only acquisition you need to make. I've had many clients, as you know, my book on company growth by acquisition,
that's right.
many
By the
clients
way,
who have bought multiple companies. And yeah, it doesn't mean, and it doesn't, so that means, don't think you have to buy the biggest possible thing right off the bat.
right.
Because you can always buy a smaller one and buy another one and another one. And it is really true that I'd say there's a darn good chance after a while someone in your industry is going to say, "Hey, It's time for us to exit. We noticed you buy and the people that like working for you. I just had one 2 years ago. That's it. The largest guy made 4 acquisitions. The largest one was the last one, bigger than his other 3 combined on sales volume. And they came to him and said, "We've seen you buy 3 companies in our industry. Would you be interested in buying us?" And he did.
Yep. I've seen that too.
Yeah.
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 Well, I actually saw it in the franchise business, but they go to a trade show and everybody's walking around going, "Hey, I understand you buy, you buy businesses."
Yep.
Like, yep, we'll do it.
Okay. Hey, it's been a pleasure.
Yeah. John, thank you so much. By the way, John Martinka, he's been doing this for over 100 businesses, 20, 30 years now. Got 5 books on Amazon. I've got 2. John, thanks for being on my show.
Yeah, it's a pleasure. I think we could have gone on for hours.
I love hearing knowledge. All right, I'm going to stop this and get. I hope this video has inspired you. If you need help buying your first $1 million business, make sure to visit me at dealflowsystem.net. If you like this video, make sure you subscribe down below. Comment on it, share it, tell everyone about it. And thanks for watching.